Schwab Advisor Services is proud to support the RIA Edge Podcast and equally proud to support independent financial advisors like you. In a challenging year, how did 68% of firms surveyed in Schwab's RIA benchmarking study meet or exceed their new client goals? By following key success factors, such as leveraging new technology, adapting strategies to win new business and stay connected with their clients, while also attracting and developing the right talent. The Schwab RIA benchmarking study is just one of many ways they provide you with the insights and resources needed to succeed and grow. Get the full picture at advisorservices.schwab.com. Hello, everyone, and welcome to the RIA Edge Podcast. This is the time and the place where we interview executives who are on the forefront in growing the business of financial advice. This is the place where we hear from folks working for or with registered investment advisory firms that are, according to our analysis anyway, not just growing, but growing in a sustainable way and with strategic intention. As we like to say here, firms that are growing by design and not by default. Of course, there are lots of paths up that mountain, and my guest today is going to help us map it out. Rob Madore is the vice president at Marshberry, a consultant in the financial services space, and according to my crack research team, a former professional hockey player. So maybe we could talk to him a little bit about that. But we've worked with Rob and his team at Marshberry on a pretty extensive research project here at wealthmanagement.com through our partners at WMIQ, which sought to discover how RIAs view growth opportunities, how they're preparing their growth plans, how they're executing on growth strategies, how they're accommodating what in some cases can be a pretty substantial jump in the size and complexity of their firms. So Rob, thanks very much for joining me on the podcast to talk this through.
Thanks for having me, David. Looking forward to our conversation.
Yeah, I appreciate it. We've had some a long partnership here with some of this research that we're doing and continue to do with you all at Marshberry. And I think I want to maybe start off by thinking, probably about this time last year, maybe about the time that we first started talking about this research, there was a feeling in the air that a recession was imminent, right? Historically unprecedented acceleration in interest rate hikes was coming. Yet growth expectations that we saw from the research for RIAs, their own growth expectations, were only tempered modestly. I think that was one of the top line takeaways. RIAs still seem to have a pretty sunny view of how they're going to grow in the future. Any reflection on that, on how, what that says about future growth opportunities for RIAs going into 2024?
Well, I'm certainly never against positivity. I think the challenge for RIAs is truly, looking at themselves and growth and where it's coming from, not over the last 5 or 7 years, but kind of using the change in the market to kind of, lay bare where it's actually coming from and how much of that they control and how much is market driven. So I'd say it's great to see that that positive outlook, but I think it warrants, if you're the CEO, the president, COO of a firm, it warrants you kind of pulling back the sheets and saying, where's this actually coming from? Is this growth that we're actually driving, or is this growth that's just kind of falling into our lap because we build a nice base of clients?
Right. And for a long time, that was kind of so we got almost growth by default, right? I mean, for the past 10 years, everyone was a genius in this space because the markets just kept going up and up and up, and so did the revenue. Feeling that there was going to be a bit of a reckoning here in the markets. Maybe that's not coming to pass. I don't know. It doesn't seem like the advisors' viewpoint has changed that much. Did that surprise you in the study, or?
Absolutely.
Yeah,
absolutely it does. I mean, if you're a student of the game, so to speak, it's hard to ignore not just a study like this, but there are a number of great studies that, kind of come out quarterly. And I think what you have found, and I'm generalizing here, but what these studies are finding is that RIA growth has actually been pretty low. And the kind of the benefit that I and others on my team and others that kind of exist in a similar position in the industry have is you get to really dig deep with your clients and look at kind of the financials and pair qualitative, quantitative. And I'd say that the vast majority of the cases are in line with the findings of those studies versus kind of the hopes and dreams that I think we're finding more in the results of this one.
right. So take me back then. So this has been a debate for a long time, the notion between organic and inorganic growth. Uh, and certainly advisors are hit with all kinds of messages about growing organically. Um, Yet we kind of look at the market as a whole and wonder, is there any organic growth to be had, or is it just kind of cutting up the pie in different ways? I, what are your thoughts on organic growth?
Yeah, I'd say I am bullish on the ability for firms to drive it. And I'd actually say that, to borrow something from one of my colleagues who I really respect, Kim Kowalski, it's really about setting a strategy and then executing on a strategy. And I think if you do that, you actually can drive new client growth, and you can drive what we would term as organic growth. But it's it's the simple things that are hard sometimes. And I'll stress, like, this is not all right now, David, RIA owner, you need to come in tomorrow, January 1st, because you're focused on organic growth. You need to be picking up the phone and kind of, looking at a virtual phone book and then just and dialing 100 names a day. I don't think it's that. I mean, it's even simple things like paying attention to, centers of influence and building a culture of referrals and focusing on the client experience to kind of enable that. So there's multiple ways to create this organic growth, that new client growth outside of, you need to become a cold calling machine.
Right, right. Interesting, the notion of centers of influence and relying on those for organic growth. One of the things I thought was surprising out of the study that we found, it seems that digital marketing or growth through digital channels seem to have dropped in importance with advisors. And any reflection on why that might be? It seems that advisors have been told for a few years now that, got to get your digital marketing machine up and running. That's going to be the way of it.
I have my suspicions, and nothing is based on, more fact than I find in a study like we all did together, or others in the industry. But, sometimes I wonder if it's a departure back to what used to be normal, right? When you think about a lot of these high-end RIAs that hold a lot of assets, have great client trust, how did they build their business, whether that was 15 years ago, 10 years ago, or even kind of pre-COVID? I would imagine that the vast majority of them were doing so with in-person type events, outreach. And I tend to wonder when the market, when the market fluctuates and you don't see the kind of growth you have over the past, 5 or 7 years, and you've invested a little bit more, maybe over the last 18, 24 months in digital, I wonder if you kind of return to what was normal pre-COVID and say, this is how I built my business. I'd like to kind of go back to what was working in the past if I have the desire to increase growth, organizationally. And I think the other thing is, and this is more of a talking out loud as opposed to a hard and fast number, but in my opinion, digital marketing and digital efforts are something that have a cumulative effect on, brand awareness and new client growth. And so, maybe the question for you, David, is do you think it's a reflection that maybe the patience to allow those channels to really be leveraged to their maximal abilities is not necessarily there with the average owner, right? If you're spending dollars and cents, it's a lot easier to say, hey, I had 8 people at a dinner, than it is to say, I got 200 impressions on LinkedIn campaigns that we're running and have been running, right? One is a little more tangible feeling, and one may actually have greater impact, but you just don't know when it's coming through. So my question to you would be, do you think that means that there's probably a more patience needed on some of these? Because I don't think one channel is the key, but let me stop and let you answer.
No, I think that's exactly right. It reminds me of the old adage that they used to say in advertising, 50% is wasted. We just don't know which 50%, right?
That's good.
So it's something that you kind of, and I think maybe this is why it's dropped in importance. It doesn't necessarily mean that it's dropped in the study in usage, but yeah, maybe some fatigue in a realization that the channel has to be there. You have to show up in those spaces. Anyone who stumbles across an advisor looking for a relationship, even if they're referred by a COI, is going to, first thing they're going to do is check out the Google and see where you pop up as an advisory firm. So those channels are, have to be there, but maybe the realization, you're right, some sort of fatigue is setting in where it's not seen as the panacea.
Yeah, certainly. Yeah, I think there's always a tendency, doesn't matter what type of business you're in, there's always a tendency to look for the easy button. And
Right.
I mean, if one exists outside of the Staples commercials, I certainly haven't found it, but if you have, please let me know.
So from the research that we've done, and we're not going to go through the details of the research here. I mean, the folks listening who are interested can certainly find it and download it on our website. All the data is there, and it's an interesting read. The gathering what we did with that data, if I were to ask you, I'm an advisory firm, I'm setting off on a growth strategy here. I want to accelerate growth. I don't know which way to go. I don't know the avenues to choose. What would you tell me? What is the how would you advise me?
You're bringing the $1 million question up front, huh?
Yeah.
So I'll take probably an unorthodox approach to that, which is the first thing, at least in my opinion, the first thing you need to do if you want to grow sustainably, and not just in the short term, but over the long term, is you have to look at your own business and say, one, are we prepared to actually support this growth? Right? It's kind of the chicken or the egg problem, right? Do we build the client base and then figure out how to support it, or do we build the support and figure out where the clients come from? But I'd say you look, especially for the firms that traditionally listen to these, right? You've got the 500 million, the billion, the billion plus, a lot of really good firms and growing firms. You already have an established client base, and that's where you start. Or at least that would be my recommendation, is before you start thinking about where you're investing dollars to improve and to continue growing, you want to look at your client base, right? Where did they come from? Who are you serving well? It's the old client segmentation, right? Becoming experts in who you want to serve and how you serve them, and how you serve them best will allow you to then figure out where you get more of them. I think that's the place to start for me.
Yeah, that makes sense. And it also strikes me that there's maybe for firms that are still led by principals, founders, the entrepreneurial spirit there is probably to take the shoot first, ask questions later approach, right? Where
No
you're
question.
constantly putting out fires, and you're constantly, it's like you kind of leap before you think a little bit.
Yeah. Well, you kind of brought up the sports angle, which we certainly can dig into, and I'm sure I'll make a few jokes at my own expense. But when I was playing sports, what you heard a lot of trainers, coaches say to some of their most talented athletes, which I was very rarely one, is they'd say, sometimes it's about working smarter and not working harder. And I think that applies here, which is, to achieve organic growth, you first have to understand like where you want to grow in terms of clients. And so, by doing that, you enable your firm, your advisors, your people, anyone you hire, who are going to be a driver of that organic growth, to know where to find them, how to find them, how you serve them, right? It minimizes the wasted effort and having to fix, like you said, right? You run so fast, sometimes you have to fix things down the road, and you're never going to get away from that. But I think in this case, if you've built a successful practice, you have a nice client base, you have all the tools, to determine that next step for organic growth, and it exists within your clients.
Let's talk about M&A then as an avenue for growth.
My favorites.
Yeah, that's the one, right? I mean, I think that's what's been driving a lot of the growth that we've seen in the industry for sure. This space, the independent wealth management space, is a billion stars that are kind of quickly coalescing around a few big bigger planets. Talk to me about the M&A market as it stands now and what you see when you look out there. Are we seeing a slowdown? Are we seeing an acceleration? What's happening?
I think just kind of starting big picture, this is certainly not the first industry to ever go through some sort of consolidation. It's happened for years and years with railroads and, mom and pop grocery stores and so this is a fairly natural thing. And so you can kind of look at other industries, like I think David, you and I have talked about before, and say like, what's happening here? Where are we? And I often reference the Harvard Business kind of consolidating industries follow, 4 phases. And so it's very natural for an industry to go through this, where it's, it starts out with kind of a fragmented industry. And then, in phase 2, you start to see the start of consolidation and increasing acquisitions, some capital flowing in. Phase 3 is building the actual platforms and making the things hum, right? Actually leveraging scale. And phase 4 is when you have kind of, you have that end stage consolidation where the big gobble the big, and you have 3, maybe 3 to 5 players owning 75% of the market. For anyone that works in the institutional retirement consulting space, that's, record keepers like Empower are a great example. You've got 3 to 5 that own the majority of the record keeping world. So it's an example of like a relatively recent, phase 3, phase 4. So when it comes to wealth management, I think, we're probably solidly in that phase 2 or 3. And there are all sorts of outside factors certainly playing into this. The cost of capital, certainly does impact it. But there are so many independent advisory shops. There's so much demand to get into this business. And there's, at least theoretically, so much opportunity to create value with scale that we haven't necessarily seen, that precipitous drop over the past year that may have been, forecasted when the market went a little wild and interest rates went a little crazy. And while this year is down a little bit, it's still, it's still only 10% or so off of, that record high in public, and I stress that in published, or public transactions, because not every deal is something that hits, the PR newswire, or wealthmanagement.com. A lot of them are peer-to-peer acquisitions or book purchases. And so there's a lot more, but the market has stayed very healthy and it will continue to stay healthy, in our opinion, over the next 5 or 10 years. There's just a lot of runway there. And there are a lot of factors, I would say, even increasing the supply, over the next few years.
Did you tease anything out of the research which might suggest firms approaching M&A, making that decision, the ones who are doing it in the right way versus the ones who are just kind of, like we said before, kind of pulling the trigger and thinking about it afterwards?
As far as acquirers, I think there's, that probably, before we talk about some of the key pieces of the data or stats we, pull out of that, I think it kind of, you almost need to pull back too, and then start to define M&A or succession from, I'll call it from the seller's lens, because that's oftentimes where I work. And you say, like, how much of this is I have to sell my business, or it's like kind of a forced thing, versus how much of it's strategic, right? So like, why we talked about, like, where are we in this consolidation of the industry and what's going to happen, but why are firms selling, I think, is the other key piece before you get into, what's the study telling us about, how these firms are planning on going about it over the next, we'll call it anywhere from 1 to 5 years. And the why, and I'd be curious for your thoughts on this too, David, but the why that we often see is it's the difficulty in doing so internally, right? Most of the firms that I work with have the intentions of transitioning their business to a successor that's already in-house, or kind of that Gen 2 advisor, or Gen 3, or even a team of them. The second is growth, right? It's a challenge to grow, like we've talked about, and sometimes the only way to access certain levels of growth, like custodial referral programs, is to be a part of something that's much, much bigger.
Mhm.
And the third is, a future for their people. I mean, you could probably say a fourth is the ability to kind of monetize a life's work, right? And, or take some chips off the table, but it's really, it's growth of the firm, it's growth for their people, or it's an inability to actually transition internally. And I think that within each of those, you've got kind of a blend of do I have to do this as a business owner? I don't know. What are your thoughts on that, David?
Yeah, no, I like that framing. I think that's correct. For a long time, it seemed the uh, decision to sell your firm was a monetization opportunity at the end of the career, right?
Yeah.
You've built this thing and now you're going to retire, so you sell it. I don't. That seems to be. It's almost like the industry seems to have kind of matured beyond that a little bit. I don't know how many willing buyers there are for firms that seem to be kind of at the end stage of the principal's involvement, right? I mean, a lot of times those firms are decumulating older clients. I just don't know how valuable they are anymore. But that notion of not being able to find an internal succession is what's interesting to me. Because you're right. I mean, most people seem to say the way that I'm going to do this is by selling it to, transitioning it to a junior advisor. Why do you think that's so hard for folks to pull
Well,
off?
there's a number of reasons, and some are more quantitative and some are qualitative, in my experience. And the easiest to talk about is the quant, right? The last 10 years, unless you're living under a rock, you realize, one, there's a lot of consolidation, and two, the values for good firms just continues to rise, right? I'd say valuations as a whole are maybe plateauing, and it's the best firms that are getting the high multiples versus, once upon a time, there's this phrase in, investment banking. It's like, if you can fog a mirror, you can get a high multiple. We're not necessarily in the, in that landscape anymore, but there are still these great values for top firms. But just unpacking that a bit in relation to internal, because I think one of the stats we found in this too, and I may misquote it and I'll need you to correct me, but it was somewhere in like 35-ish% of firms that are involved in a transaction, there's some sort of an internal. And even if you dig, into this most recent one we've done, there's a lot of intention to do internals.
Mhm.
So if you think about the growth of the overall value, let's like compare internal versus external, right? There's always going to be a discount, and it starts with understanding, how these transactions are undertaken, right? And external, you find a strategic partner, you find the fit, and it's a little more of a business transaction, right? You're going to look at a pro forma, you're going to figure out what your business is worth, you're going to figure out how you fit inside this new business and what kind of additional value they can add, to your firm. And then ultimately you're going to choose whether you're doing it with just one or you're doing it with multiple. You're going to choose based on some blend of financials, fit, culture, what makes sense for your clients, what makes sense for your people.
Mhm.
Um, but it's a lot more of a quantitative exercise when it comes to the value of the firm. You don't have to do it. You don't have to sign the papers, right? On an internal, it's a little bit different because you've got, it's kind of more of the handshake, right? You need to have two or multiple willing parties. You can look at all the stats and say, and I know there's a number of them, but it's somewhere in the high 30s, maybe around 40% is the average discount between an external transaction and an internal transaction. But it's great to have that number in hand. But at the end of the day, if I'm the owner of a firm, I need to go to my Gen 2 or Gen 2s, the David Armstrongs of my firm, and I need to say, hey, David, I want you to take this business from me. I want you to buy me out. You need David's buy-in on that, right? You can't force David to do anything. So it's great to have that 38-40% number in your mind, but at the end of the day, it's about finding something that works for for both of you, right?
Yeah.
It's got to be that handshake. It's got to be that agreement. And that's only become more difficult over the past, 5 or 7 years, because the market has continued to rise, right? Most fees are somewhat correlated with the market. So that means your fees continue to grow, your revenues continue to grow. And therefore, even if the external multiple you're receiving is stagnant, right? Your growth doesn't necessarily increase your multiple. It's still creating this increasing delta, right? Between an internal and an external. And so the longer you go without starting to transition that business, the more difficult it is, because you might say, hey, I'm going to do this in 3 years. Well, chances are your firm's going to be worth more in 3 years than it is today, which makes it even more unrealistic from a dollars and cents perspective to do it internally. And it's very hard as a business owner to say, you know what, I think what I'm going to do is take a 40, 50, 60% discount on the business that I built over the past 20 years. Yes, I recognize that my people have helped me build this, but it's a pretty big haircut, and a lot of risk to stay involved, trusting that my generation 2 or generation 3 can actually, maintain the standing of the business and continue to grow it. The other side of that is more qualitative, but let me just stop and let you sound like you may have wanted to say something there.
No, it's a pretty substantial discount. And then when you add on to that the time commitment that a lot of the internal transitions take, and a lot of the effort that internal transitions require, you're right. I mean, the calculus doesn't necessarily favor it.
Now, yeah, and the risk side, right? An internal term, typically 20, 30% down, a buyout over 5 or 10 years, right? It's a lot of it financed through cash flow. There's risk involved, and it's not necessarily the like total handoff, total de-risk or majority de-risk that a lot of owners get to when they get into their late 50s, early 60s. The other side of it is the employees themselves, right? Like we like to say that if you're going to do an internal succession, it's not a point in time effort, right? It's not just you wake up one day and say, I'm going to turn my business over to David, my junior advisor, who's been with the firm for 5 or 10 years, right? It has to be something that is ongoing. It needs to start probably 10 years earlier, because you need to overcome and these hurdles in regards to the attitudes and the willingness to take on risk from employees, right? Most of the generation 2, if you're kind of generalizing across the RIA industry, were brought on as employees, and the owner or owners, primary owners, had already kind of built that stable base where they're able to provide a little less of a risky proposition in joining the firm, where it's the employees aren't necessarily the entrepreneurs that the founders were, and so they're not as comfortable with risk. And the reason I say it's not a point in time thing is just saying that, David Armstrong, you're my Gen 2. Like, if I come to you tomorrow and say, hey, David, I'm really excited to have you buy me out. You are my successor. Here's how it's going to look. It doesn't matter if you give them a 50% discount, a 60% discount, a 30% discount on the external value of your firm. It's still a significant increase in risk. There may be some sort of personal guarantees from them, right? They have to figure out, like, it doesn't matter if it's $100,000 cost or a $10 million cost, right? It's still it's still a shock. It's still a change in mindset for a lot of these employees who haven't necessarily been given the leadership reins, strategic control, or had to have taken on, that risk where they're going home at night to their husband or their wife and saying, hey, honey, we're really growing. I'm really believing in what we're doing. And for that reason, taking out a loan and using the house as collateral. So it's kind of a total shift for a lot. And that's why it needs to be trained, over 10 years.
Yeah, a difficult road for most. So let's say the principal or founder or owners of an independent firm are then maybe thinking, okay, internal succession is not the way. We're going
Mhm.
to sell ourselves on the open market. My view is that we talk about how valuations really haven't come down that much for advisory firms, but the buyers have gotten a lot more sophisticated. Would that be something you'd agree with?
Yeah, I would agree. Yeah.
So what is a firm that wants to position itself for a sale? What do they need to think about? And
That's
what are the characteristics of the firms that
yes.
succeed and get the valuations they're looking for
Yep.
versus those that aren't?
Well, if I'm always a fan of making things simple, and we could probably go into minutia. And I really enjoy what I do, just like you do, David. So we could be on here for hours and hours, and no one would ever listen to the podcast. But if to make this really simple, one is growth, right? Is this firm growing? Is it growing above market? Like that is the key. It doesn't matter if it's a peer-to-peer acquisition. This is something that we actually saw in some of the data we worked on together, David, is
Hmm.
growth is the main driver for acquisitions. Firms want to acquire other firms that are growing or merge, right? Depending on how you structure it. They want to merge or acquire other firms that are growing. And the second is people, right? So we just spent 5 or 7 minutes talking about the generation two advisors and how difficult it is to transition it, which I will emphasize, it is possible. It just takes a
Mhm.
lot of intentionality and a willingness to get it done on both sides. But the Gen 2 advisors and staff, those who serve your clients and those who are going to be there speaking to a business owner long after you're gone, those are actually some of the primary drivers of the value of your firm. So it's always you're kind of on a knife's edge at times, right? You gotta make sure you keep them happy, you engage them, you bring them into the growth of the firm, so everyone's kind of growing together. But at the same time, like because you can't lose them because they're such a key part of your firm's value. And at the other time, on the other hand, you have to always keep in mind, like it's really hard to bring them in. But to directly answer your question, it's growth and it's people.
Yeah, I was surprised to see the acceleration of cultural fit jump to such
Yep.
high level of importance among firms. I always kind of have been suspicious of culture as kind of a squishy word that
Yep.
discussion kind of went away when the checkbooks came out, but it's really not, right? It's not. I mean, it is a real tangible
Yep.
element.
Well, and I think it's something that's very achievable for any, whether you're an acquirer or someone looking to sell your business or merge your business. It's really achievable right now because there's so much option. There's so many options out there. Whether you're looking for a strategic, a partial, a merger, like there are so many options out there. Like it doesn't have to be I give up the money and it's either money or it's fit. It can be a measure of both, and sometimes a perfect fit in both. And I totally agree with you, David. I feel like SEO might have picked up on culture in RIAs once upon a time, and so I think we're almost it's the wealthmanagement.coms and others out there. There's lots of talk about culture, right? Half the M&A panels at the conferences are talking about the importance of culture, but I think it's like what does that actually mean? That's the
Yeah.
challenge. But I am as a firm that focuses a lot on fit. I am encouraged by seeing that the world is starting to wrap their heads around that. Yeah, it's another old saying on that too, is like, if you think the marriage is expensive, like wait until you see the divorce. And that's kind of pretty applicable here in regards to culture and M&A, which is it's a lot more difficult to unwind a bad one because you didn't find the right cultural fit than it is to just do your due diligence up front.
Yeah, one of the phrases you used in our prep call here was acquisition as a crutch.
Yep.
What do you mean by that?
So that kind of goes back to what we started talking about. And I think it's really relevant too, because if you look at the data, I think it was what the data was saying from this most recent study we did is about 86% of firms, if I was reading it right, had intentions of doing something in the next year in regards to a, merger, sale, buyout, debt, equity raise. So there's a vast majority that are thinking about doing something, and then 98% are planning on doing something in the next 5 years. So just about every person that responded is looking to do something
Right.
with their firm
Yeah.
over the next 5 years. So it's really relevant that this point, which is, if your firm is not necessarily growing on its own, it may make sense to figure out why that is and to fix that before you go out and start to try and acquire as the strategy for growth. And I would point to the largest, successful national acquirers, integrators, aggregators, however you decide to term them, and say they are all growing heavily through acquisitions, certainly, but they're not like foregoing organic growth. It is a combination of the two. And if you bring that down to the independent individual level, what I am trying to emphasize, I would say, is that M&A and acquisitions will not fix any of the structural issues that are preventing you from growing in the short term. It may actually just, kind of paper over the cracks in the short term, and over the long term, end up crumbling things.
Mm.
So that's kind of what I referenced there. And I think we could certainly dig into that, but it's M&A is certainly a way to grow, but you got to have a really strong foundation if you want not just your first acquisition, but all subsequent to actually be successful.
Right. So this is, you got to set the table beforehand, before you go out into the market.
100%.
And I guess my question about, if in your experience, the buyers are getting more sophisticated, I'm sure you see some wild swings in valuations between firms that have that table set and firms that don't. Everyone wants the number, right? What is the number? What's the number? I guess I won't try to pin you down on an actual valuation metric, although I'd love it if you had one. But given the wide disparity in there, can you reflect a little bit on how much of the swing you've seen out there in the marketplace in valuation?
If I was going to give you an actual number, I might have to go back to my compliance team and get it approved. Let me, because we got plenty of data on that too. In regards to the kind of the variance, right? I mean, we spoke about it briefly, which is once upon a time, 5 or 7 years ago, when things were really getting going, and maybe even into, all the way up into 2022 at times, there was such a demand, there's so much capital available that you may not have had to have, call it, 9 out of the 12 value drivers. Like we like to look at 12 value drivers for when we're representing a firm or helping someone kind of plan out their acquisition strategy. Maybe it was, or let's actually go to sports, because I like sports, right? You could say in baseball, you got the 5 tool players, right? And that's kind of how you look at a player if you're a scout. I would just, what I would say is there is a wide variance now between a 5 tool player and a 4 tool player, whereas maybe a year to 5 years ago, not necessarily the same variance, right? 4 tools getting treated as a 5 tool and a 3 tool is getting treated as a 4 tool. So it's just, there's a shift to quality, and that has certainly changed. I would say more of the variance comes like when you say sophistication, a lot of the times sophistication comes with partnering with outside capital. And that could be kind of like, the Oak Streets of the world who are helping firms finance acquisitions, where now you kind of have that someone else kind of looking over your shoulder and kind of helping you manage, and you're really managing the business as a business. That actually improves and makes you more sophisticated in your acquisition strategy, because you have to be, you have to look at how a firm is, are they accretive or not accretive to you on a financial basis? And it starts to hone what you're looking for. But but more so when you look at kind of the firms that have institutional private equity behind them, those are the most sophisticated buyers because, oftentimes they're partnering with firms that have a lot of M&A expertise on the private equity side, and they typically bring that down to the local level. And so you see a lot of sophistication, and then there's naturally a learning curve. A firm that's never done an acquisition, it's you don't know what you don't know. They may not know what to ask, for their first acquisition, but by their fifth, they know to ask different things on lines of revenue. They're going to know to talk about different pieces of technology and understand like what's easy and what's hard to transition. They're going to understand about how to transition between, accounts between custodians if they need to be. So I think the sophistication comes from a combination of where the capital's coming from, right? Is it out of the partners' pockets, or are they leveraging debt, or maybe, some sort of institutional capital behind them? And the other is just riding the bike. The longer you ride the bike, the better you get at it. So, and then that certainly has driven, the capital itself has driven a lot of the variance too. It's very hard to compete as an independent firm on dollars and cents with a firm that has institutional money behind them.
Right, for sure. It strikes me, and we're kind of running up against our time here, and I have more question, but it strikes me that the valuation drivers that you talk about, the 12, and I think we can, intuit what they are, and they're,
Sure,
they're in the research study, growth, people, et cetera. I guess when I talk about a more sophisticated buyer, your analogy is a good one. The notion of getting your house in order, having your business processes clear, having your growth trajectory sustainable, makes you a valuable acquisition target. Maybe not for every buyer, but for the right buyer, right? We talk about a lot of acquisitions take place now because firms are looking for specific skill sets or specific entry into specific client demographic.
Yep.
So the notion of tidying up the house so that you'll be attractive to every buyer is maybe not the right way to look at it.
No,
You want to
definitely not. Agreed. You got to find the right fit, and I would say something that's always easy to understand is like, what clients do you serve, right? Again, going back to where we started in regards to growth is what clients do you serve, and how does a potential partner firm, if you're looking at an acquisition or excuse me, being acquired or merging, are they serving the same types of clients? How are they serving them? Are they doing it the same way? You don't want to go somewhere that's not serving your types of clients and doesn't have the offerings, to support it, unless you're kind of leading the charge there. There's an equal, there's 12 kind of value drivers that we track that drive the enterprise value for a seller, but there's another 12, that sellers should be evaluating buyers on too.
Yes. Getting more complicated, but the opportunities aren't going away. So
Exactly.
Rob, this has been great. I did want to, we're pressing up against our time here. I know I've kept you too long already, but I did want to just ask you about your history with professional sports, because I didn't know that until recently. So tell us a little bit about it.
Well, I like to say that I think my marketing team has a higher opinion of my professional sports career than reality might. But it was I played a few years when I was done with school. I played hockey, and I like to say that at the beginning of a season, if you're a fan of your local team, and I played for 4 organizations in 4 years, so it tells you about how much they like keeping me around. But I guess I'm the millennial of professional sports. But I like to say if you showed up to the preseason game and I came out onto the ice, you'd probably wonder why you paid $50 to watch the game. But I did get my jersey, and I did play 4 years, and I was, I did all right at it. But
Well, that's fantastic. Not everyone can say that.
Yeah,
You were a hockey player, but Toronto Maple Leafs, did I see?
Yeah, so I finished up my last year with the Maple Leafs organization, so contractually with the Leafs. But I played throughout those 4 years. I kind of went up and down between levels, starting in starting in the NHL typically at the beginning of the season, and then kind of working my way down and bouncing between AA, AA and AAA, kind of depending on the year and time of year. But
Well, still, it's an achievement. Not everyone can say that.
I'll give you a story, David. My last year with when I was with the Leafs, like you as a player, when you go into training camp, you oftentimes, when you walk into your locker the first time for the first preseason game, you can see what number the staff has given you. And typically the number that they give you is kind of an indicator of whether or not you actually have a chance to be on the team, right? If you're good, and I was a goalie. If you're a good goalie, you're like number 29, 30, 34, 33. And my last year, I was all hyped up, had a good off season, walked into the, to the locker room for that first preseason game. And lo and behold, in my stall was the number 73. And I remember I called my wife and I said, I don't want to be negative, and I will try not to. But 73 is not necessarily a great sign. And here I am working in finance.
Well, that's all right. That's all right. I mean, you consider like all the people who dream of careers in professional sports at any level, and never happens for them. So that's great.
It was great. Not many people get to do it. I was very fortunate to do so.
And Rob, we're fortunate to have you on the podcast. So thanks very much for the conversation. I would encourage anyone who has an interest to look for the research at wealthmanagement.com that we did with Marshberry. Download it. It's filled with a lot of good data, very enlightening. So Rob, thanks very much for the partnership, and thank you for joining me.
Thanks, David. It's nice being with you.
And this has been the RIA Edge Podcast. Thanks for listening. Schwab Advisor Services is proud to support the RIA Edge Podcast, and equally proud to support independent financial advisors like you. In a challenging year, how did 68% of firms surveyed in Schwab's RIA benchmarking study meet or exceed their new client goals? By following key success factors, such as leveraging new technology, adapting strategies to win new business and stay connected with their clients, while also attracting and developing the right talent. The Schwab RIA benchmarking study is just one of many ways they provide you with the insights and resources needed to succeed and grow. Get the full picture at advisorservices.schwab.com.